Institutional capital is shifting right now, and retail traders are entirely on the wrong side. Today, we're mapping the exact liquidity footprints left by smart money. Let's decode this institutional flow in today's explainer. Here is the setup. The strongest currency right now is the New Zealand dollar. The absolute weakest is the US dollar. The ultimate play? A short pullback on NZD/USD. Our main target is the daily EMA premium zone. That is exactly where institutions sell at a premium. But here's what most traders are missing. You do not sell right now. You wait for the trap. So, what's smart money likely trying to achieve next week? A massive capital rotation. This is driven by extreme central bank divergence. Where retail sees a trend reversal, smart money sees an inducement phase. They're deliberately driving price higher simply to capture sell-side liquidity later. Let's break down the exact institutional positioning. Capital is flooding into the New Zealand and Australian dollars. This is fueled by risk-on sentiment and commodity backing. Meanwhile, the euro and pound are reacting to cooling inflation and beta sensitivity. What about the bottom of the list? Safe havens are lagging hard. The US dollar is paralyzed by a severe data shock. And the yen? It's completely abandoned as volatility crashes. The macro catalyst here was a catastrophic non-farm payrolls miss. Only 15,000 jobs were added against a 114,000 forecast. Simultaneously, the VIX volatility index just crashed by over 8%. The result of this shock? Capital aggressively fled the US dollar. It rotated straight into risk-on equities and commodities. This is classic macro flow in action. The next liquidity target changes everything. Next week, the RBNZ is forecasted to hike rates. Meanwhile, upcoming FOMC minutes loom with extreme dovish sentiment. This fundamental divergence is the absolute fuel for the market. It provides the exact catalyst needed for an impending liquidity sweep. Zooming out to our multi-timeframe map, the weekly structure reveals mature bearish order flow. Price remains heavily suppressed under the 50 and 100 EMAs. The long-term institutional footprint is undeniably bearish. We absolutely do not fight this macro trend. We align with it perfectly. Dropping down to the daily structure, price stretched way too far into discount territory. Simply put, it became too cheap, too fast. Seller fatigue quickly set in as the RSI hit deep exhaustion. This triggers mechanical mean reversion. The market literally has to breathe before the downside resumes. Now the H4 chart reveals the illusion. Momentum has flipped aggressively bullish, with the RSI pushing near overbought levels. But this short-term momentum is deliberately engineered. It's a classic bullish inducement phase. It is precisely designed to build retail confidence in a fake reversal. Smart money may be creating a trap right here. Retail traders are frantically buying this H4 breakout. They're totally convinced the bottom is finally in. But institutions are just patiently waiting. They want premium pricing at the daily EMA before executing massive shorts. Don't get caught in the middle. The internal market structure acts as a giant magnet. Remaining liquidity pools sit directly above current H4 prices. This buy-side liquidity is exactly where retail stop losses rest. It serves as an algorithmic draw on liquidity. Price will push higher to sweep those stops. Once triggered, smart money will distribute heavily. Here is the definitive institutional trade setup for NZD/USD. We're targeting a short pullback. You must wait patiently for price to reach the premium zone. That entry is between 0.5780 and 0.5850. Place your stops safely above the daily order block. Target the absolute low at 0.5635. The logic is simple, multi-timeframe alignment. Just let the pullback exhaust. Every institutional trade requires strict invalidation parameters. A high-volume daily close above the 0.5850 structural high completely destroys this bearish premise. If that level breaks, the algorithmic draw permanently shifts. But until then, our short bias remains absolute. Always remember this core institutional truth. Liquidity leaves footprints before price leaves trends. We don't try to predict market tops or bottoms. We simply wait for the entire system to synchronize. Trade with logic, not emotion. To follow future trading opportunities and detailed market breakdowns, you can open your trading account with FXTM using the link in the pinned comment. Stay disciplined and wait for your setups. The liquidity pools are waiting out there. Will you be the one sweeping them or the one getting swept?